Okay, let's handle some of the questions from last Sunday's Market Outlook. First one, personal question. Do you have a plan or idea how long you will keep doing the Applied series? It is truly amazing, but must be very time consuming. I'm hoping for many more years, but do not know if that's realistic to expect. Like you've said, at some point you have to stop outsourcing your thinking. Well, when I say you have to stop outsourcing your thinking, I meant more in terms of you would stop listening to somebody saying, buy this stock. But education, you can't outsource your education. Well, I shouldn't say you can't outsource your education. You have to continue to outsource your education because you don't know what you don't know until you learn it. So you do have to listen to other people until you say, oh, okay, now I know it. And then you can think for yourself so that you don't have to listen to somebody say, buy ABC. How long do I plan on doing it? That's a good question. I don't see an ending for that for me, 10 or 15 more years. Right now, a shameless plug, it is 320 USD, and there is no expiration on that right now. That doesn't mean there isn't going to be some expiration at some point. And I just keep adding to it. At some point in the future, I think about 4 years from now, about 4 years, there will be an annual subscription for the editions. But when I do that, it won't be for those who already bought. So you'll buy up to a certain point, and at some point, anyone who bought before that point will simply just have, till I die, or till I say, you know what, it's been a good run, it's been 10 years, I'm done. After that point, you'll get the entire library for the Applied series, but any new editions would require an annual fee. I don't know what that looks like yet. Really, I don't. I'm just sort of thinking ahead, but right now I have no plans for an expiration date. I have no plans to stop, and I'm just going to keep adding to it. Let's see, what else have we got here? Sticky CPI is just mirroring Shelter, which has the heaviest weight in that category. If you click download data on the Atlanta Fed site, you can see sticky CPI values X Shelter, 3-month annualized 3.9, X Shelter, sticky CPI, sticky core 3.5, much more tolerable numbers. I make 3.5 sticky CPI a tolerable number. 80-year long-run average headline CPI is 3.8. Sticky should probably be a bit lower. Fed's mandate is on PCE. It is on the PCE. So how do we find out what component that is? I think there's another question later on that asks about the weighting of it, and I will show you how to find that when we get there. Q&A, could you please explain who are the participants in the repo market? Typically banks with extra money to park somewhere, or mutual fund companies, mutual funds that have access to the New York Fed window or have access to the repo and reverse repo market. It's not just for everybody. It's specific participants. The number that you put out as the reverse repo facility is the reverse repo facility provided by the Fed. The New York Fed handles any and all open market transactions. But yeah, the Federal Reserve sets up the facility, but the New York Fed handles all open market operations. Let's see, I have studied quantitative methods for level 1. I remember you saying applying CFA concepts as a retail investor can be deadly. Don't know if I used the word deadly, but that being said, I was wondering how hypothesis testing can be used as a viable part of a retail strategy. There aren't many applications for it. If you, on this channel, there is a folder for applied videos that I've done in the past, and there's one in which I look at the spread between lean hogs and live cattle. Usually it has a 50-cent spread between them. But sometimes the spread widens. Well, that can't hold because if beef gets too expensive, people switch to hogs, and that will drop the price of beef and raise the price of hogs, right? So there is a mean reverting level between the spread, which is 50 cents. Well, how do you know how many standard deviations away you are? Usually if you're more than 2 standard deviations, it represents a good pairs trade. you would have to do an analysis of that, which means you're going to use some sort of regression for this. You're going to get some sort of beta I shouldn't put a capital B because we're using samples, some sort of beta coefficient. You're going to have to test whether or not that is significant. Because if it is not significant, well, then there's no relationship there, right? So anytime you're regressing something on something else, your coefficients to test whether they're significant, you'll use hypothesis testing. For the retail investor, I mean, that's starting to get kind of specialized, especially when you're looking at pairs and deviations from pairs, to know how many standard deviations away you are. There has to be a relationship, first of all, so there have to be significant coefficients. And from that, you'll get some measure of variability in the sample that you used. So it's useful, but I'd say that maybe less than 1% of retail investors probably break out regression and hypothesis testing. Are there any market voices or analysts, commentators, academics, fund managers that you think are very good and they've consistently found to be worth your time? Howard Marks, as far as fund managers, I think he's the most level-headed of all. Anything on YouTube that you can find of Howard Marks. I have his last book. He sees the market more behaviorally. He thinks in cycles, which, at least he's upfront about how he views the world. I view the economy as a complex adaptive system that does not have linear equilibrium, but has a different equilibrium. Even if you move from one point to a new point and you think you're moving back to that point, it is going to be a completely different equilibrium that you move to. So I see it that way. So the idea of saying, well, this happened in the 70s, it's probably going to happen now, I don't like that idea. The idea of looking at chart patterns to say this happened in the chart, it's going to happen again. No, there's no reason why that would happen again. If you look at chart patterns, they happen again as often as they don't happen again. That to me sounds like something random. But he's good to listen to. Another site I like is a Marcus Academy out of Princeton. Really good. Every week he has somebody on with intellectual gravitas. It's not just somebody trading Bitcoin out of the basement telling you, how wonderful crypto is. None of that stuff. This is intellectual gravitas on this one. Another one you might want to listen to is University of Chicago, the Booth School Distinguished Speaker Series. That one is really good as well. And I think Wharton has a Distinguished Speaker Series as well, so you can check that out. Usually the really good universities will have, if you go to YouTube and you type in the name of the business school, you'll get their site and just go to their site, click on videos. Usually they have a speaker series. Those are fantastic. If you want to kill an afternoon listening to 3 or 4 good speakers, those are fantastic. So that should keep you busy for quite some time. Let's see, last Friday we saw consumer staples rallying while the market as a whole was meh. Do things like this give you more confidence in your negative beta position? Well, usually when the market is weak, consumer staples, healthcare tend to hold up the best. So that is a typical footprint of a flight to safety. Equity in portfolios that have to be in equities will tend to move towards lower risk securities, which is lower beta. Those are found in things like healthcare and consumer staples. Consumer discretionary usually is the worst performer. So if you have a down day and all the sectors are down, it would not be surprising to see communications, information technology, and consumer staples being the 3 worst performers, with consumer staples and healthcare being the better performer. And real estate will be at the bottom of the list or the top of the list, depending if real rates went up or down that day. In a future video, please share your thoughts on liquidity conditions. Fed reverse repo, Treasury general account, Bank of Japan, and People's Bank of China injections. I think you mean just the last one being injections, and how those factor into the market outlook. I'm sure many viewers will find that helpful. Well, you're not going to like my answer, which is I don't really pay attention to that. It's people who pay attention to little liquidity issues, and I'm not going to belittle it by saying little liquidity issues. Let me erase that. But by looking at, in these corners, looking at the plumbing of the central bank system, I think to me it's like gold bugs. Looking at this little factor that happened over here, and this holiday season in India is 1 week earlier, and they buy gold, and it's this and that. It's like, well, wake me up when it's something is sort of what I think. But I myself am not seeing liquidity issues in anything that I'm doing right now. I'm not finding it. I'm not seeing wider bid-ask spreads on anything. Mind you, I'm not in the treasury market. I'm not buying and selling treasuries along the curve in different countries. So maybe fixed income traders might be seeing something saying, the spreads are kind of wide compared to where they were 2 years ago. But I'm not really seeing too much of anything. My thinking on all of this is that it is a big deal for the Federal Reserve. Good enough. I got somebody looking out for me. It's not like it's the captain of the Titanic, full speed ahead in the middle of an iceberg field. I'm not too concerned. And really, it's not my thing. I just, I don't really get into all those little dark corners in the technical details. So I know my answer is probably unsatisfying for you. Also, would love to hear your comments on the rise of 0 days to expiration options. And whether those are increasing market vulnerability, as JPM's Kolanovic argued recently. Market vulnerability or intraday volatility? Are we sure we're saying the right thing? They're probably contributing some degree to intraday market volatility because, well, there's got to be a dealer on the other side that has to hedge out. And when the option expires today, especially the ones that are at the money, your gamma is moving that delta very, very fast. You've got very high gamma, so delta can switch from 0 to 1 to 0 to 1 rather quickly throughout the day. So hedging that must be difficult to do. There is a lot of it going on, but by the end of the day, it's all over. That's the whole point about 0 days to expiration, is once you start getting into the close, it's pretty much over. There are none. And then, the next day somebody buys options in the morning for the day, and by the end of the day it's gone. So it doesn't show up in the VIX because the VIX doesn't count options that expire today. After there's, I think it's like 17 days left to expiration for the option ahead, it starts jumping to the next option to try to keep it to an average of 30 days. It weights the two, so it doesn't use these options. It's a lot of gambling. If you're using 0 days to expiration, I have a hard time believing that you're hedging something for, that there's that much hedging for 1 day. I think because it creates intermarket volatility, it draws people into these options, because if you buy or sell at a swing, at one of the swings of the day, if the volume is there, it'll swing back the other way. So, somebody somewhere is probably making some money on these until that disappears. And it disappears when more people start talking about it and everybody starts doing it. Then suddenly the premiums disappear on those 0 days to expiration, or the spreads get so wide because dealers don't want to touch them that it doesn't become a market anymore. I don't know that it increases market vulnerability. Maybe it could. I don't know. The thing with the options is you'd have to have, I think, a bunch of people all on one side continually pushing them, so that the dealer would continually have to hedge by buying and buying and buying and buying, and you'd have to have it being pushed even more. I don't know if it's that coordinated at this point. So I don't know. Other than odd days where the market goes up and then it goes down, then it goes up and then it goes down, you look at these are odd price moves. If you want to give me the reason that the volume of these options is causing that because dealers have to continually hedge, okay, I'd say, yeah, probably some of that intraday volatility can be explained by those options. Curious as how you're managing your agency position. I'm not right now. I'm just long. I'm not managing it at all. All the talk of recession positioning. Well, rates will go down, spreads will increase, but mortgage-backed securities should be well bid. So I'm not too concerned about that. Let's see. If rates are cut rapidly, would we see a sharp increase in refis? Well, I think you would. I think if I got a 5.9% mortgage and in 18 months I see that I can refinance for 3.5%, I'm probably going to do that. How can we think about or analyze prepayment risk in these investments? Well, the lower rates go, the higher prepayments are. And the shorter the duration of the mortgage-backed security is, the shorter the duration it becomes, the less price sensitive it becomes to changes in rates. So as rates keep dropping, there is a limit to how much more price appreciation you can get out of a mortgage REIT. Is it possible for MREITs to have so much refinancing it could counteract the appreciation effect from a falling rate environment? Well, the refinancing doesn't happen at the mortgage REIT level. It happens at the mortgage level, which is something that is within a bond called a mortgage-backed security, and the REIT holds the mortgage-backed security, not the mortgages. Now, they would get cash flow into their business because of that prepayment, and then they would have to go out and reinvest in those environments. But mortgage REITs are not too concerned about the interest rate. Mortgage REITs typically hedge out the interest rate. So it looks like this. You have an MBS, and there is a spread that the MBS has above whatever the U.S. Treasury happens to be. Typically, it's a spread above the 10-year, because the 10-year is close to the duration of a 30-year fixed mortgage, considering prepayments in a normal speed environment. Speed, we're talking about the PSA. That is how you measure the speed of an MBS. So this is the spread. So there is some spread above the Treasury. So if we think about the yield, it looks like this. There's some part that's the Treasury yield, and there's some part that is the spread. What mortgage REITs will do is they will hedge out this component, and then they will use leverage for the spread. So even in a low rate environment, the spread may be lower, but the spread is still there. It's not as I shouldn't say it's not as volatile as the U.S. Treasury, but if we see rates go lower and lower, there still is the spread. And then they use leverage, anywhere from 9 to 12 times leveraged once they isolate the spread, because that's where their income is. So in environments where where they're getting prepayments and there's refis and more activity in the mortgage market, it just means there's going to be more MBS that are issued. And as long as the spread is healthy, especially if interest rates drop a lot and the spreads increase a little bit, they get their prepayments, they can roll them into other MBS that may have the same or even wider spread. And if rates are going lower and the mortgage market is picking up, they may move their leverage from 9 to 10 to 11 to 12. So they can do quite well in those environments. So I don't see that as much of an issue. Unless you have a credit crisis and housing-led recession, then all bets are off. All bets are off on that, because the question will be whether or not the mortgage REIT can arrange its financing, because since it uses leverage, it has to access the credit markets. It has to access the repo market and the dollar roll market. And if that dries up, if that tightens up, there goes the leverage on mortgage REITs, right? But if you don't have that going on, if it's just a garden variety type of recession where everybody's just, I'm tired of buying, and everyone just gives up for a while, and you have a common garden variety type of recession, I don't think it's going to hurt the mortgage REITs. Well, I mean, not to the extent that 2007, 2008 did. The reason it hurt there is because you had no idea what was in those MBS. You had no idea what kind of mortgages were wrapped up in there. Sure, they said it was AAA, they said it was agency, but later found out it was just a bunch of junk, and then nobody wanted to lend against any of that stuff, so leverage went away for the mortgage REITs. Which means their whole business model sort of went away very quickly, and everything on their balance sheet was suddenly extremely questionable. Unless you get a repeat of that, I don't see much of an issue there. Question, what are your thoughts on increased liquidity in recent months and its overall bullish repercussions on financial markets? Michael Howell gave an interview on this idea recently on Blockworks Macro. Well, a question earlier talked about decreased liquidity. You're asking about increased liquidity. Again, I don't really know too much about liquidity. I know there are different measures. BIS, Bank of International Settlements, has measures for global liquidity. If you just Google this, measures for global liquidity, there's lots of good papers on it. And lots of different sources that already have measures of global liquidity, and you can see what composes the measure, how they come to their measure, and the elements that make up what they are measuring when they talk about global liquidity. Again, it's just not my thing. Should we be concerned about the U.S. debt ceiling? No, not really. I think what the U.S. debt ceiling highlights is the laziness of the voter, that we no longer require anybody that we elect to actually be competent, only popular, and only to say the things that we want to hear. And the more we think they can embarrass the other side, the happier we are with them. The more they want to own the other side, punish the other side, the more we're happier with them. And that usually leads to more and more extreme candidates. So you got a backlash against wokeism. You're going to say, I'll show you a thing or two. I'm going to elect the most right-wing candidate I can. We'll show you. We'll crush your ideology really fast. And this is what it's devolved into. If you want to know or understand the true, not the proximate cause of the debt ceiling crisis, but the really true underlying cause, it's the voter. It is the unwillingness of the voter to do any kind of thinking anymore about what does your resume look like? What have you done? What experience do you have? What do you believe in? What is your ideology? We don't do that anymore. Not at all. If you did, somebody like George Santos could never be elected. Would never get elected. Some of these wackos on both the left and the right, in both the Democrat Party and the Republican Party, never would have been elected. It's the laziness of the voter that has caused the debt ceiling crisis by allowing these lunatics, basically lunatics really, that probably couldn't get a normal job. All these lunatics to suddenly have a decision about how the very country you live in is run and what crisis you need to live with now. Come on, man. I mean, in your own business, you'd never hire some of these people. You'd never hire some of these people. They're idiots. Yet somehow we think that, no, let's give them a shot at making decisions that will affect my lives and the lives of my family. So should we be concerned about the U.S. debt ceiling? We should be concerned about democracy, because this is a symptom of a broken democratic system where we no longer have elections, we have popularity contests, and we hate the other side so much. We don't really vote for qualified candidates. We vote for candidates that can just punish the other side. Articles are saying a default may occur late summer. Well, it's not saying that it may occur, that if it's not resolved, there's the potential for a default late summer to early fall. I know we've been through this before, and DC has always been able to reach a compromise, but it feels more precarious this time. Yeah, more stubborn and irrational voices on the Hill. Yeah. Curious to know your thoughts on those of others in the forum. Well, here's the thing. If you're going to have a crisis, let's just have a crisis and get it over with so we can clean this whole mess up. But if we avert this one, if there's no fallout from electing lunatics, we'll elect more lunatics until the fallout will be something we cannot live with, until the fallout will be just the destruction of the structures of society itself. We almost saw that a couple of years ago on January 6th, the almost destruction of the very structures of society. So if we keep doing this, that's where we're headed. So perhaps what we all need is a good slap in the face right now from the rest of the world. If there is a default, yeah, okay, let's see how that feels. Maybe we just need to be reminded how bad that actually would be, so that next election we think, okay, we can't have this anymore. We just can't have this anymore. It's time to get back to something sensible and responsible. You know, what educational background do you have? What relevant work experience do you have? What do you believe in? Let me hear your position on the facts, please. What are the facts in your mind? You got to get back to that. So maybe this is just what you need, and if you don't have it, and government might just get, you know, more and more of a lunatic asylum until they break something that really hurts, right? With regard to your applied series, I'm wondering if it is geared towards individuals who have recently passed the CFA exams. I would say if you've recently passed all three, you'll pretty much understand everything I'm talking about. You may not have seen it applied before, and it may be illuminating to say, oh, that's how that works, or okay, that's where you get this from. But you'll understand it a lot better. I'm taking level 1 in August. Would you recommend to focus on CFA exams, or would you say the applied series can be a good concurrent tool? The applied series is a good concurrent tool which will help you on the exams because it'll give you context. I mean, I can describe something, but for many people, when you describe something, it sounds abstract. So I can describe, what an option trade is. And if you've never had any experience with options or seen an options trade before, for you it's like, okay, well, you got to remember a bunch of stuff, calls and puts and long, this has positive delta, that has negative, and this and that. But when you see it actually applied, it starts to come together for you. It's like, okay, I see what you're doing there. And because this has that feature and this has that, that's why okay, now I see it. So it's an example of the concepts, but instead of using some manufactured example like John wants to buy a stock for $50, a call is selling for $5. That's the typical example you'd find in a book. This is real world. This is just a whole bunch of real world examples of the concepts that you'll find. I already answered this one down here, but I'll answer it for other people. Top-down business cycle of the applied series, you introduced the ratio inventory to sales as a leading indicator. Later in the video, I know as a conference board, LEI included it in its, it's the conference board period. LEI is leading economic indicator. In talking about lagging, the lagging index, it's in the lagging index with a weight of 1.1211. Yeah, I've seen some textbooks and some economics books listed as a lagging indicator, some listed as a leading indicator. I've always seen it as a leading indicator. Inventories building is a sign that something is on the horizon. I see, this was a big thing in 2007. I lived in Windsor, and the airport was right around, just on Walker if you're from Windsor. The car factories are around there. There's a long part of the airport that's just undeveloped land, and there's a road going through it. And GM was parking all of its, was it GM or was it Chrysler? Chrysler was parking all of its cars there, all the holding lots that it would park its vehicles in, when those trucks come and they pile 6 or 8 vehicles on them and they drive them away. Well, those lots were full and they were using the airport as overflow. So they had massive inventories just building. You couldn't help but see all the cars just parked there. Well, that is a sign that something's going on. They're going to have to cut production at some point. They're going to have to lower their orders to all the feeder plants in the area because they got to work off this inventory. To me, it's a screaming leading indicator. I don't know why they have it as a lagging indicator, but I'm sure they have some narration somewhere as to why it's a lagging indicator, but I've always used it as a leading indicator. We keep hearing the Fed talk about services ex shelter. As you mentioned before, that is the category of wage price. Well, it's primarily where wage price inflation is showing up. The weight for those come to 12%, even if you include energy service, is still only 15%, and they're quite volatile. Well, you're looking at CPI. You have to look at the PCE, and the weighting of it is a little bit, you do have to do some math to get to it. So find the personal income and outlays report, PCE, table 1. You're going to want to go to we're going to get PCE this Friday, by the way. going at PCE this Friday. Go to table 1, go to line item 34. This will be personal consumption expenditure. This is the amount that was spent on personal consumption. This is the C part of GDP. You know, C plus I plus G plus, you get it, right? It's the C part. And that number was 17,737.2. And then if you go down to line 38, you'll find services. The lines before it are goods, durable, non-durable. You'll find services, and that was 11,844.08. Well, you have to divide it, right? Let's back that up. So take 11,844.08 over 17,737.2, and you will get 0.6678%. So the services expenditure in the personal consumption, for personal consumption expenditure, represents 66.78%. Let me get rid of that decimal place. 66.78% of all personal consumption expenditures. Then you have to find a shelter weight. Well, you're not going to find this in this report. You're going to have to get a little creative and Google that. You'll find it's around 16.5% within PCE. Versus 33 to 34%, 32 to 34, depending on the year and where you're looking. I think the last reading was 34% on rent and owner's equivalent rent, 16.5%. So you're right around 50% of personal consumption expenditures come from services ex housing, roughly about 50%. Medical care is somewhere around 20% of PCE, but in CPI it's only around 8%. So medical care is overrepresented in the PCE. Owner's equivalent rent is underrepresented versus what CPI is. This is everything spent. CPI covers about 71% of that. So of all the things that are spent in here, all the things that are purchased, they show up in here. CPI measures about 71% of the price of these things. So that is why the Fed uses PCE, because it's the consumption part of GDP. It's what people actually spend. It measures it basically is their method of coping. Whatever they're buying, if prices are high in one area, they will switch to buying something else. So it's the best coping number. So it measures really their cost of living as opposed to the general price level. It measures how they are adapting to changes in the price level by substituting to a cheaper brand, buying stuff on sale, using more coupons. The services component makes up 66% of that category. And the PCE is their favored gauge to look at. So it's 50%, and they estimate that roughly 55 to 60% of what's in here comes from wage inflation. All right. Would you please explain equilibrium model in simpler terms? So an equilibrium model assumes that you are in equilibrium. So if we think about economics, you think about supply and demand, it assumes that you're in equilibrium. Well, markets don't necessarily have to be in equilibrium. So if we take the equity market, for example, over the long term, if you go back 80 years and you look at where we are today and you imply a growth rate, that's called a CAGR, compound annual growth rate, with reinvested dividends, you're around 10% per year. But that's an average. If you look back through the historical record, the market rarely returns 10% per year. That's an equilibrium point. So that in equilibrium, over the long term, we can assume an equilibrium. The expected return on the market is 10%. Well, what if the market is overpriced? And you buy the market when it's overpriced? You're buying it out of equilibrium. So the market can do this, right? Like this is the return on the market each year, right? So it passes through equilibrium, but it's out of equilibrium here, it offers a higher return. It's out of equilibrium here, it offers a lower return. When we use an equilibrium model to estimate the cost of equity, we make it a function of whatever the risk-free rate plus we think, well, there's a market risk factor and there is some premium to being in equities. and we get some expected return based on these observations. That assumes that the market is in equilibrium, that we have an equilibrium, an expected equilibrium return. These are called equilibrium models. Well, if you're here, that's a nice model. But if you're here, 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 here, anywhere off the line, well, you're out of equilibrium, right? That's what that is. So equilibrium models are, can kind of give you the middle of a distribution, the expected return from wherever you happen to be, because there is some power in still using them. You may think, well, if we're rarely in equilibrium, why use them? Let's assume that the market does this and ends here for the year, and this is the longer term trend. Over the longer term, we would expect that overshoots will be met with undershoots, etc., to get to some longer term trend. But at this point, we would have been forecasting that we would have had this type of distribution, that the equilibrium point was the middle of the distribution. But we're up here. When we're thinking about the next year, we can just take this line here and shift it up, and we should return the same amount. At this point in time, the long run is still 10% per year. So in 1 year, we would expect the return distribution to look like this, that it is still possible the very next year to earn the expected return. If we assume independence, that the return in this period is independent of the return in that period, then you can still embrace an equilibrium model for a 1-period estimation of what the expected return will be. But that's what those models do. So there is still some value in it if you assume that the return here is independent of the return here. Question is, are they truly independent, or is there some effect of the return here that then spills over into here? Or is this a very mean reverting series where if you have 20% 1 year, expect to have a less return than the average the year before? Maybe you'll have this and then this and this kind of thing. So maybe there is some kind of serial correlation from year to year, or never mind positive serial correlation, maybe there's some kind of negative serial correlation in there that suggests that that series is more mean reverting than we would like. Then, if you have that, then equilibrium models probably aren't the best to look at. So there we go. Regarding the Standardine LLC bankruptcy, the private credit markets, given we're keeping an eye on OAS spreads on a week-to-week basis, wouldn't we start to see credit spreads widen given the deterioration of credit quality of the issuers? Well, we would. If there is stress in those markets, you would expect to see spreads widen. But there's a big difference between a company that can't access the private markets paying 13% interest on their debt versus a company that can access the private markets and even in high yield are yielding 8%. There's a big difference between those two. Let's see, increasing leverage, loan-to-value ratios, decreasing interest coverage ratios. If private companies are having trouble with keeping up with their higher payments due to the increasing interest rates, or is it that the OAS spreads are strictly based on public company data? Well, that's it. OAS is public company data. So there may be risk that we wouldn't see signals of this for the private markets. Well, you don't. In the private markets, that's a whole point. Private. Unless somebody wants to divulge some information for us, you're not going to see it in the private with the private markets until you hear about it. So it is not very transparent. Public markets are transparent. A lot of people are looking at it. A lot of credit analysts are looking at it. So if there's a problem, they see it coming, right? Or is it the OAS spreads are strictly, there it is. Lastly, I would think that this would only apply to debt with a variable component for the benchmark rate used for coupons. Private debt will more than likely be variable rate. More than likely be variable rate as opposed to fixed rate. Yeah, so let's see. I came across an indicator from Richmond Fed that reminded me of your last video about unemployment index. It takes into account all non-employed people, and it's been ticking down as well. It's called non-employment index. I'll have to look that up. You may find it useful. I have one question this week. I understand the play on recession through TLT and S&P. They may be negatively correlated, which will smooth out returns. However, I don't understand the usefulness of the Fed funds futures bet instead of just adding to your TLT or S&P position. Yeah, it is. You can argue that, well, if you do have a recession, why not just use duration? Why are you betting on the Fed funds futures? If you can use TLT, it takes a lot of money. Like, it just takes a lot of money because it's $100 a share. So if you're going to buy TLT, it takes a lot of money. It's an ETF. It's going to have management fees. It's a constrained duration ETF, which means they are perfectly willing to sell bonds, even if they have to sell at a loss, and then buy bonds to manage to keep their duration in a particular range. You can use leverage to buy it, but only up to 50%. So it's inefficient in that sense to buy. So you can use the options as well, but options on a $100 ETF are going to come with big margins. So you can use ZB. And when you use ZB, you're getting duration because ZB is the 30-year bond, right? So you're getting duration. The underlying here is anywhere from a 15 to a 25-year bond. However, you have the March, the June, the September contract. June has liquidity. But September has no liquidity, so you can really only go out to June, and you're going to have, if you're long, you're going to have negative carry, because the curve is inverted right now, and if the curve is inverted, the futures curve for treasuries is in contango. If you have an upward sloping curve, the futures curve is in backwardation, you get positive carry, but here you have negative carry, so you're going to be faced with negative carry. If it's one of these plays of I think it might happen, rolling these over is going to require a lot of negative carry. For the Fed funds futures, I can go right to December and make the bet with no carry. Well, now it's working against me, but I didn't think that as soon as I bought it, a recession would happen. I'm not that concerned about it. So there's no carry, and if interest rates drop, that thing pays off nicely. It requires very little capital to put that trade in place. Very little capital in terms of the margin that I have to give up. So it's super efficient in terms of capital, and it has no carry, positive or negative, has no carry at all. So it's just one of those extra little things that, well, I want to lean into it a bit more. I don't know when it's going to happen. I want to avoid as much negative carry as possible. So this is just one more way of grabbing some return off the Fed move without having to pay too much for it. What else have we got? Could you elaborate a little further on why your short Strangle helps keep you in the short position longer? Should the market continue trending down, wouldn't you just keep your short position if you had conviction at 38.50? So I had the short puts. The short puts would increase in value as the market dropped, right? So now that I got the short Strangle, as the market is dropping, if I feel, well, I'm feeling maybe this is it, I can, the short call up here, I can take profit on the short calls and at least lower my position that way and just stay in the game. I always find that if I can get some options around what I'm doing, just empirically, my behavior changes. That when I have options in place, I tend to stay in the trade a lot longer than if I don't have options in place. Because you start feeling the market, and you say, okay, especially volatile markets when they're doing this kind of thing, like that kind of stuff. If you have this idea that I'm just going to hold, you could 6 months later you could find, well, I've gotten nowhere. Yay, and okay, I'm back to even. But all of that time with that capital and you've got nothing. So you have to be very tactical in volatile markets. In trending markets, and I'll write the word down, you can be strategic. In volatile markets, you have to be tactical. Strategic means I'm going to hold this security, this security, this security, this security. 5% here, 6% here, 7% here, 2% here, and I'm going to hold some others with about 8%, and you have this allocation that you're going to hold. That's your strategic allocation, and just hold it. Yeah, markets do this, but if they're trending, you can live with. You don't have to be tactical around that trend. But when they're doing this kind of thing, or even this kind of thing, and they're doing that kind of thing, and bear market rallies are sharp, right? You have to be more tactical. You have to be willing to step in, step out, step in, step out. And it does get tiring. I mean, it's been, almost a year now of this tactical positioning. It works well because it keeps your portfolio volatility low. Your Sharpe ratios look nice. Once you get a hold of the market, in the beginning it's going to mess you up, but once you figure out how the market is moving and you get a hold of it and you balance out your portfolio, you can do quite well on your portfolio value with very low volatility. But you must be tactical. Selling the calls just allows me to be a little bit more tactical. So that when we have a drop in the market, I may look at the calls and say, well, I think we're going to get a rebound. Why not lower my calls? Well, let's take the calls off. At least I've taken profit out of that side. It just gives me another opportunity to harvest profit on one side of the trade or the other. And I do end up staying in trades longer when I have options because options are working. So it's just... sometimes I can explain what to do. Other times I can't explain how to do it. And I've used that analogy quite a bit. So what to do is the science of finance, right? If you expect interest rates to drop, you buy bonds because bond prices will go up. That's what to do. How to do it, how to get your duration exposure, that's an art. Right? So that just comes with experience. When you combine a science and an art, you get a craft. And this is a craft. So I can explain a what. As far as a how goes, me selling calls up here is part of my how. It's more of a craft. That's the part that's the art of what I do. I don't know if that answered your question. I think the 5-year inflation expectations are too low. What is the best way to play this? I did answer that. If you think they're too low, you buy the tips. You can buy tips and sell the nominal, but as a retail investor, I doubt if you're going to get that done in any retail account. But there are, I think if you Google it, there are some ETFs that will play inflation expectations that in behind are actually doing that kind of thing. On your long FFF December play, I've got a why now and a why then question. I believe there's a case to be made that in the short term, the December contract will dip as Fed speak starts to sink in and sentiment adjusts to the higher for longer. Yeah, and it did that today. Down, the curve is now down 94.64, is going into August, September, October. And December is handing me a loss. Yep. Do you believe that's already priced in and or you wanted to get in ahead of PC and jolts? Not really. When trouble shows up, it shows up all at once. It doesn't creep in slowly. Things that creep in slowly, markets can still continue to function quite well. Earnings are okay. Companies adjust. It's when something goes wrong and it goes wrong all at one time. It happens very quickly. Things fall apart very fast and rates get cut very quickly in response to that. Usually intermeeting cuts. And they don't wait till there's a meeting. Usually it's announced 8:30 in the morning. We're going to emergency cut of 50 basis points to stabilize markets. There's some event that happens somewhere. And there are exogenous events that happen all the time that are typically negative. If you're in a high growth environment, if you're in an ample liquidity environment, the system can absorb these exogenous shocks. But when you're in an environment where rates are increasing, money supply is shrinking, credit is becoming available only to the best qualified people. Banks are getting a little bit more concerned who they lend money to. You get a shock to the system, and you get credit pulling in even more. Credit is the lifeblood of the entire economy. You shut down credit, within 2 weeks, you've got a dead economy. If you shut down credit, it's over. Everything just screeches to a halt altogether. So it is, you can turn off the power to a city for 3 weeks and it'll find a way to adapt, but you shut off credit, things break, things fall apart. Well, that shows up all at once. That's my play, is that given the environment that we're in, it's kind of like the man with a gun theory. That if you want to start a revolution, all you need is a society that's ready for one and a man with a gun, and it'll just snowball from there. And that's kind of what a low growth environment is like. Is all you need is a credit event, and then everyone gets worried and off we go. So that's all it is. It's, I think, probably more speculative, but I can keep rolling those forward without any real loss. Yes, I'm underwater and they're derivatives, so they're marked to market. So I have lost everything up to this point that my negative sign is in front of. So if it says negative 6,000, that means $6,000 has left my account. But you can continually roll them forward until they hit. So I'm not too concerned. Also, given the company balance sheet fortifications of cash positions, do you believe there's a possibility that economic distress hits after December? I'm sort of thinking that when forecasters, when I hear people saying, "Oh, I don't think there's a recession in 23, it's more like in 24," they're forecasting something that is probably going to be exogenously led. You can't forecast that. All you can say is, look, exogenous events happen all the time. That we're not going to have an exogenous event till 2024 is a ridiculous statement to make. We are. The question is, how big is it going to be? Where does it hit? And what's the contagion effect? Keep in mind that it doesn't have to start in the U.S. It can start anywhere in the world. It's not just the U.S. that we're concerned about. It's other countries doing what they're doing. Something can break somewhere else that causes a contagion effect, right? I mean, the late 90s showed us that can happen. What are your thoughts on investing directly in real estate? Not a big fan of it. I saw a lot of people living in Toronto and pouring money in southwestern Ontario. Prices have retraced, but still above 2019 level. Yeah, but there is negative carry with a house, right? You have insurance, you have property tax, you have maintenance and repair, you got the roof, you got the HVAC. Sure, you can get a tenant in there. But the tenants can sometimes cause more damage than the money that you receive. It is a big negative carry position. Why not just buy an apartment REIT that's already doing that, or a housing REIT that's already doing that? And you get rent checks on the 15th of every month. You don't have to paint any apartments. You don't have to go in and clean up. You don't have to evict anyone, hire lawyers. You don't have to have a real estate agent show the property because you're out of town. You don't have to worry about selling the property and losing 5% to a real estate agent. And you get your rent check every month. And there are some good apartment REITs out there that are paying, 5%, 6% dividends. Are you going to get that kind of cap rate on a house that you buy now? If you're buying within your particular region and you're in a decent enough region in terms of tourism, like the Toronto region or Vancouver, and you're going to Airbnb, buy condos in one building and then buy as many as you can and Airbnb them, you could probably do quite well, because the shorter term, the shorter the period you can rent it, the higher the rent you can get. But you're a property manager, and that comes with all the headaches of being a property manager. If you're thinking about real estate as a passive income, make it completely passive. Don't get involved in active management. My thoughts on it? Yeah, I'm not that big on it. What kind of things do I should go back to this a bit. I think that comes from when I was younger, living with my grandmother, who owned an apartment building, and I saw the work that had to be done in turning over an apartment and getting an apartment ready. And then in high school, I worked for a company that owned a whole bunch of apartments and was also developing houses and building houses. So I was the guy that would go in, wash the windows, clean the carpets, and paint. You're turning over these apartments. I didn't paint as much as other people did, but you basically turned over the apartment. You go in and do all of that stuff. Some of the stuff that when you go into the apartment, you look, you go, holy Jesus, and you're seeing the cost to turn over that apartment, and it's just, as I got older, I thought I never want to be involved in that business at all. You got to have an appeal for it, I think. What kind of things do you enjoy outside of financial markets and maple syrup? I enjoy the ongoing process and don't mind putting in the hours of work, but want to see if you had tips on maintaining a life balance. Well, you do have to have a life balance because your brain can only function at a cognitive level for so long before it just wears out. You got to give it a break. The gym was always a big thing for me. I have my own in the basement now. I've done well enough in life that I can actually just build one in my basement and be done with it. So there's that. I have a pool outside, so in the summer I hang out there when I need an hour or two off. And then there are some TV shows that I like to watch. I have Crave. It's the only one I have. I got Apple TV as well. There's some good series on there. The Last of Us it's interesting. It's a better story than Walking Dead. Walking Dead could have told this story, but they just every week it was zombies here and this group of people fighting that group of people, and season after season it went on for far too long. But this is interesting. Each episode seems to be a contained story that I kind of like the approach they're taking. So I do that. But I have a treadmill and I have a TV in front of the treadmill. And my rule is I can watch all the TV I want if I'm on the treadmill. That's it. If you're just going to sit there and stare at the TV, it's just not something I do. That's about it. I don't go out. I don't drink. I don't do any kind of recreational drugs at all. It's just nothing that I care to do. That's it. When we think about maintaining a life balance, if you love what you're doing, is it work? I mean, is it really work? So at some point you say, I've been doing this for 4 hours, but it doesn't feel like work to me. So maybe I just got lucky and I found the right space where what I do looks like work, but it's not. I'm sure Standard has some competent people. If jumps in projected terminal rate are that crippling for the company, wouldn't it have made sense to hedge with interest rate drops? Okay, so I did answer this. There are some replies under here. They might not have been a good counterparty for a swap, or there might have been a restriction in the debt that said that you cannot use swaps because swaps work two ways. What if interest rates move the other way and there's a cash outflow that you have to make? Well, that reduces your debt serviceability. There might have been something in the contract for that. More than likely, as a private company, they probably just weren't a very good counterparty for a swap. So if they had gone to their bank, if they're getting private credit, they didn't get it from their bank, right? So if they go to their bank, perhaps the bank might say, well, it's nothing that we would do. You don't have the loan with us. Maybe a dealer didn't like the risk that they saw and thought, well, are you even going to pay us? Well, look at this, where they are now. Also, when they got the loan, they might have had a belief that interest rates just really weren't going to go where they were going to go, and probably felt they didn't need it. Since they had floating rate debt, they thought, well, interest rates will go up for a bit, then they'll start going back down and things will get better. Well, you're not going to hedge something that's going down because that's good for you. So it could be a bunch of reasons, but probably the biggest one is they probably weren't an efficient counterparty. And if they were accepted as a counterparty with the credit risk, the swap would have probably not been very, with the spread between what they got and what they paid, receiving one interest rate, paying the other, probably just wouldn't have been worth it. Hi Mark, would long ticker RINF, ProShares Inflation Expectations ETF, be better or worse than buying tips? I don't know. I haven't looked at that ETF. I'm aware that there are ETFs that do this. and it is probably doing something in behind along those lines. So it's just a matter of reading what it does, and if you're comfortable with the way it structures its portfolio, you look at its return series over time versus inflation. Has it actually been a good factor, risk factor in terms of paying off for inflation? If it has, off you go. But this is going to be a much more actively managed ETF, so look at those management fees. Wouldn't surprise me if they were upwards of 0.4, 0.5, 0.6%. Thank you once again for some great videos. 2 quick questions. In the Applied Market series, where do I find the additional retail sales analysis? That is in the market updates. There are 2 folders in the market updates. One is extras, and that is, I checked earlier today, that is up. On the duration trade while using TLT and not just implementing in the bond futures options, excluding the ZB short puts. Well, I'm doing both. I do have I do have the short puts on ZB. With bond futures, you really can only go out maybe 2-3 months before liquidity really starts to fall off. And because there's a delivery period for the futures, right? So you can't hold the futures once the delivery period starts. So for you, and every retail trader really, the expiration of bond treasury futures is 1 month earlier than the month that's listed, and then you have to roll over. If you're trying to get like a leap done, a 1-year leap, you just simply can't get it done with bond futures and options on futures, because there's no cheapest to deliver that's listed out that far, and there's no contract. There's only 3 contracts listed: March, June, and September. September has no liquidity. Don't even try. It's not going to have liquidity till probably the end of May, when you have to get out of the June contract. Yeah, you got to get out of the June contract by the end of May. Actually, I think by the 3rd week of May, you got to get the hell out. So it's a lot of rolling your position in that sense. And if you're going to be long the contract, again, you have negative carry on that one. And it's just clumsier to work with. That's all. Now, if I were big and I needed to hedge something, or I needed to maintain a certain portfolio duration, I'm using those. Those are the most obvious things. But for speculation, they're clumsy to work with. Unless you really know what you're doing, the probability of you making a mistake is quite high. Especially if you've got to watch certain dates and roll over those things, you're probably going to make a mistake at some point that's going to cost you. TLT is just easier. Not as efficient in terms of capital as using the bond futures, but just easier. And if TLT is put to me, I don't have to worry about a rollover. I'm going to get a dividend out of it, and I have the luxury of holding over time without it having to be assigned to me. Then I can think of other options plays that I want to do while I hold it. While I hold it now, it makes it for a great income factory when you're holding the underlying. So there's lots more that I can do with it without always having to face some constraint on the calendar. How does the SOFR 3-month futures work in hedging short-term interest rate rises? Well, it really only works for a 3-month period. So let's assume that the 3-month curve, it kind of looks like this right now. Right, so let's assume that over this period of time over here, starting this period of time, well, I should say, I could do, actually, let me back that up. At this period of time, you're going to have a 3-month, you're looking for a 3-month interest rate. You need to do something for that period of time, whether you're going to pay an interest rate or receive an interest rate. And let's say you like this interest rate, but you're concerned that by the time we get to this point, this is the forward curve, that the true rate might be down here, and you like this rate. So what you would do is you would short this rate, and if it drops, you make money. And then when it comes to this point in time, you invest at this rate for 30 days, but you made the difference there by giving you or locking in that rate. It's really not for the retail investor. There's no real reason why you would need to bet on a 3-month or a 1-month rate 6 months from now or 9 months from now. These are usually embedded in contracts called forward rate agreements. There's really no reason why you need to bet on a particular rate. in any kind of volume. So I don't know that I would be looking at that as a way to play interest rate changes. In your opinion, don't you consider increased rates a sort of universal basic income for those with wealth? No. What I consider universal basic income for those with wealth is a Federal Reserve lowering rates to zero and expanding its balance sheet. When the Federal Reserve does stuff like that, the investor class gets paid first. We get paid first. Now, there's this thinking that, well, when they do that, the rich just get richer. That's not true. It's not that the rich get richer, it's the experienced get richer. But in the market, if you have experience, you're rich. So, yeah, there is some truth in the statement, well, that only makes the rich richer. No, it doesn't. Not if they're idiots. If somebody wins a $100 million lottery and the Fed does that, they're not going to get any richer because they don't know how to get in front of that. They don't know how to take advantage of that. Experience gets richer because we know where to stand and what to do when the Fed does stuff like that. That's universal basic income for people with wealth. When the Fed does that, it helps the investor class first. But the better way to work in situations is fiscal policy. But for that, you need intelligent people, and we don't have that. So experienced people will continue to get richer. Thank you very much, by the way, for all of that. What I see increased rates as being universal basic income for is retirees, because many of them are retiring with probably not enough money for them to get by, just enough money, and fixed income paid no return. Now it does. Now they can get 4 or 5% on government bonds. Now it's starting to pay a return. There's universal basic income for retirees. And that might even take some pressure off of Social Security. I don't know. But maybe it doesn't. I don't know if I fully understand Social Security. But with higher returns to bonds, the big holder of bonds are pension funds, right? And retirees. Is QT and a decrease in the money supply not a better idea? Well, there are no good or bad ideas. It's only in context. A better idea for what? To get what done? Or are they both different means of the same end? Well, QT decreases the money supply, right? With QE, it's almost as if the central bank is propping up certain areas of the market. Well, that is exactly what they do when that's the point of QE, is to prop up certain areas of the market so that they don't cause a problem to the system. I had a question on volatility. How do you see the impact of 0 days to expiration options on VIX? There is no effect on VIX, so we'll just leave that. 2 questions. What money market ETF would you suggest for a cash position? I think you can Google that. I don't use any of them, so I can't suggest any of them, but take a money market fund from a well-known family. A well-known family of funds. Most ETFs I found have much lower rate compared to Fed target rate. So I'm wondering how could we get that? Well, if I know with Interactive Brokers you can access T-bills. So maybe through your broker you can access some basic T-bills. That's what I would suggest. Regarding private credit, would you be able to show us where we can find more data to support your thoughts? Not really. That's the whole point. It's private. These funds don't have to report anything. So you sort of just hear about it anecdotally, but they don't really have to tell you anything. Few questions here, right? What are your thoughts on the consumer credit report of the Fed and its implications for the economy? In the applied series for the extras for the market outlook, I do talk about the credit report. What are your thoughts on the CBO report on the debt ceiling in the U.S. fiscal situation going forward? I've already expressed my opinion on that. What are your thoughts on how QT is proceeding? I have no real thoughts. It's going slow enough right now that I don't think it's an issue. Watch the bid to cover ratio in the Treasury market. It's still quite robust. So that doesn't mean that the large buyer that's for 60 billion that's disappearing every month is causing a hole in the market where, oh my God, who's going to buy it if the Treasury if the Fed doesn't buy it? They're still got quite good bid to cover ratios. Where do you find probabilities for various terminals? CME, Google Fed Watch tool, and you'll get a link right to it. How are you thinking about the severity of the recession? I'm not thinking about the severity of the recession. I don't really have all that planned out. There's nowhere near enough information on that. There's some probability that I think is greater than 50% of a recession, and as each week goes by and a little bit of the curtain gets pulled back every week, you get more and more clarity. But to suggest, oh, we're going to have a recession, it'll be 6.3% unemployment, real GDP will be negative 2.3, that's all fantasy. Anybody telling you what it's going to be is just making stuff up. It's all fantasy. I can tell you down a certain road roughly where we're headed. I could tell you roughly what the size of the city is based on the number of lanes that we have, but I couldn't tell you what the first restaurant we'll see is, whether it's Chinese, Mexican, Middle Eastern. I couldn't tell you, but we'll see a restaurant. I know we'll see a restaurant in the city. There will be one, but I couldn't tell you what it is. But this is a single lane highway going down this road. If there is a city up ahead, it's a village. Or, hey, we're on a 4-lane highway, double-sided. If there is a city up ahead, it's a major metro area. But I couldn't tell you what the first restaurant is. That's what the economy is like. I think we're on a road to a recession, but I couldn't tell you, what the first data point we'll see is or what they'll look like. So I don't really know at this point. When do you roll, hold, or close options position? That is the how. The what is, when you get close to expiration, if you want to keep your positions open, you roll them. How? Well, it depends on what it is you're trying to get done. This, by the way, is the next video going up in the applied series for portfolio management, is how you, once you take a position and you realize that it's working against you, how do you deal with it? And a big part of it is using options and knowing how or when to roll the options and what option to take as your opening position. So I will be dealing with this in the applied series. Whew, look at this, 4. Why use June ES instead of March? Isn't there more liquidity in March? Yeah, but not so much that it troubles me. I don't know. Just it's... you get used to doing things a certain way. I kind of like the breathing room that June gives me versus March. I don't know why. I can't tell you why. There's no real reason why I should use June instead of March. It really is just the same thing. I'm just sooner on the curve. So if we think about, when I say the curve, when we think about, carry, you have a curve that looks like this. The interest part of the carry is fairly linear. The dividend part is chunky, but over time it's fairly linear. There's March, there's June. You have this carry and you have that carry. Sure, there's more carry, but if you held it to June and then the March contract expiration and rolled over, the sum of the two carries are the same. There's no real reason that I can point at to say, hang on now, you want March because of this. I rarely, on futures, I rarely play the front month. I usually play the second month. I don't know why. It's just one of those behavioral things I have that I prefer. Psychologically, I just feel more comfortable in the second month as opposed to the front month. Again, I don't know why. So there's no real reason why. Can the credit market be so nicely regulated since the 08-09 tsunami that a major disaster event could not happen this time? A financial disaster regulated away. Well, that's the whole point of every disaster, right? You don't want to waste the disaster. You want to learn from it and put regulation in that makes sure that something like that doesn't happen again. The problem with regulating is you can get to a system that is so rigid it can't respond to a changing environment and then create a crisis because it cannot respond to that changing environment. That's what Jamie Dimon is yelling about with some of the ratios that need to be met. Is that he's saying, listen, you want us to lend and support the economy, but you're killing us with these ratios. So you could regulate something to the point that its rigidity itself breaks the system. So I don't know that you can fully regulate one away. Almost a thought experiment. Can the yield curve stay inverted for a prolonged period of time, like 5 years? Well, it's never happened. So it could make history. It's never happened, but just because something hasn't happened doesn't mean it can't happen. It's just never happened yet. What strange things would happen? Well, you'd have a volatile market, I think, for quite some time, and probably a range-bound and sideways market. Some external event would happen that would break something somewhere, though. So, no, that couldn't hold for that long. Last Tuesday when CPI was out, markets went up, taking the numbers as good news. And then two Fed chairs speak of rate hikes and the market went down. Does the market care about data more or Fed signaling more? Well, the Fed action is data. Because if Fed is going to raise rates, that's going to affect markets. So when the people who are in that room influencing other people in that room start talking, you have to start listening, because they're the ones in that room that will influence the decision of what's going to be made, and they seem to be leaning towards doing more. So those voices are going to be in that room saying more, more, more. So, there's a real probability we'll have more, more, more. You nailed it with home builders. Why not go short them now? No way. I would not go short home builders at this point in time. In fact, DHI, I had sold calls on DHI. DHI's pulled back from over 100 down to 90. I'm selling puts 88 and 80 at 89 and 87 on DHI today. No way. I would not short them. I may not feel that they've got a lot of upside. Once DHI gets over 100, I may not feel that they got a lot of upside in this environment, but they're not short candidates, number one. Not with their cash flows, not with their numbers. They are not short candidates. You only want to short something when your thesis is this is a broken company. This is a broken company. If you think that this is a good company in a broken economy, short the market, but don't short the name. If you think this is a broken company, short the name, but don't short the market. This is not a broken company. This is not a short candidate at all. For the retail sales part, I saw some videos on YouTube showing malls in U.S. are actually... I answered this one. This has been going on for quite some time. If you have the applied series, if you're going through the REIT section in the sector analysis, when I talk about retail REITs, this trend has been going on for quite some time. The square footage of malls got way too much, and with a whole bunch of chain stores, we saw that a couple years ago. All these, senseless fast fashion chain stores just declaring bankruptcy, Sears going away, things like that. What was the big one that went away in mall? Barnes and Noble. That is opening up a lot of square footage in malls, and some malls, once they lose their anchors, there's really no point in being there anymore. Then they're converted either into last mile destination places like UPS or FedEx warehouses, or converted into maybe office space or condos. But that's been a trend that's been going on for some time, and the expectation is that total retail square footage in the US still has about 40% left to shrink. So this is a long trending story. Hey, what's your take on semiconductor sector for 2023 in the long term? I don't really follow this sector very much, so I'm going to pass on this one. I don't really have much of an opinion on this, as I say, because I don't really follow it. We'll pass. I'm confused with the terms you use, such as long duration. That means, duration is a sensitivity to interest rates, right? When you say long duration, you're basically saying buy bonds. Short beta means short the market. Can I understand these as have a long position in TLT or something like TLT? Yes. Short position in SPY or something like SPY? Yes. And at the same time, you bought December Fed funds futures for the recession trade. Pretty much. There you go. With respect, your two questions out of a coma. When central banks are lowering rates and earnings estimates are coming down, bottoming, what condition is the general market in? Typically, this is the bottoming period of a contraction. Is it already rising because it's forward-looking? It is the conditions for the market to begin rising. Once central banks begin to lower rates, not right away, but when they're getting those rates down, and you think, well, how much lower can they go? They've announced probably some extra measures to add liquidity to the market to ease credit stress. And you're seeing earnings estimates being, bottoming out. The downgrades have stopped, and there's a lot more holds or even upgrades happening. That's usually the conditions under which you would want to say, I'm going in long and strong at this point. We don't see that right now. Or also bottoming because central banks cutting rates means something is broken. So, yeah, well, that's what it means. Something is broken in the economy, and we've just entered a recession. That's usually why they cut rates, is because something breaks. And when something breaks, it's unexpected. If it were expected, a lot of work would have been done to make sure it didn't break. Right now, the Fed's doing a lot of work to make sure things don't break. You may not see it going on, but they're doing things to make sure it doesn't break. When something does break, it's because no one saw it coming. That's an exogenous event, and those things happen all the time. Let's see. I shouldn't be writing questions. Oh, well, I got your questions. Could you explain what rolling forward options are and how this can be done? It just means if you have March options and they're going to expire this week, you close the March and open April at the same strike price. You just roll them forward. When you say volatility of rates have dropped, what are you looking at? You can go to CME if you type in CVOL. If you Google CVOL, CME, you will find volatility for the treasuries. Or if you look for the Treasury Watch tool, you'll get a screen up that looks like this in the bottom corner down here. There'll be a little thing you can click on over here and open the menu, and another window will open up with all the volatilities. There'll be a menu up here that's split in two. One is yield volatility, the other is price volatility. You can click in the boxes you want for the 2, the 5, the 10, and the 30 year. I did show this particular tool on a previous video, but if you just go to type in CVOL CME or type in Treasury Watch CME, you'll get to the site that has this little box. Let's see. That jokes on you were gay comment still has me cracking up from last week. Yeah, there were some comments on this. I didn't get it. Let's just look at this because I'm not sure what this is. Do you think that was a WSB gay bear reference? And I can't figure out WSB, so I tried a whole bunch of things. I thought, well, if it's a bear, I mean, is it like a white straight bear because I'm a white straight male? I thought white straight bear, is that a polar bear? Polar bear, is that a Canadian reference? And I thought, well, maybe it's a reference to Canada or something like that. I don't know. I don't get what the joke was. So, anyways, Loretta Messer saying in 20. Oh, somebody commented here. I'm pretty sure it was in response to Mark's poking fun at Tiff's feminine name. Well, I didn't say it was feminine. Baby Names UK said it was a girl's name. I thought it was a perfectly fine name for a guy. I don't know if that's what it was. Whoever left that comment, though, if you could just explain what it was, because if I had a good joke, I'd want to know what it was. I just don't know what it was. Loretta Messer saying 2025. It is truly madness to think PCE won't hit 2% before 2025. It's not yet finished, but already on the way there. Okay, so here's the thing I'll say. When you start pointing out stuff like this, showing me that, hey, look, I can see that it looks like that. This is what you're saying to me. These are not stupid people in that room, that they're completely oblivious to something that everybody can see. I mean, if they're saying that they don't see any progress going on in a particular part of the economy, it's not because they're so blind and that the numbers are so clear. How can they possibly say that? It's because what they're looking at, they're not seeing it. So they're not looking at just this. They're looking past this. They're seeing something else. They're looking at it in a different way. So just to point out, well, look at this number did this and this number did that. They're well aware that these numbers are doing these things. It's not as if they don't know this. What they're saying, if they're still saying what they're saying is, yeah, we know this, but that's not what we're looking at. That's not the data that's important to us. That's not the measure that matters. So yeah, I've seen this a lot where people are pointing out that, well, if you look at the last 3 months, we have no inflation. So, well, they're not even paying attention to that. Yes, they are. Yes, they are. They're well aware of these things. It's just, it's not measuring what they wanted to measure. That's all. Let's see. What do you think about PLW versus short treasuries? I'm not familiar with that one, so I'll pass. When you say you need to add or subtract to your futures position as you increase your break-even 41, do you mean as the market goes higher, you sell another contract at higher prices? Yep. And it goes lower, you cover it, but never really mess with your short put on ES or short call? Yep. So let's say that I have 20 short contracts on ES at 41.22, and I see the ES contract rise to 41.90. Well, 10%, I'll add another 2, maybe 3 more short positions. It comes back down, maybe 41.40. I'll cover the 2 to 3 positions. So there's 50 points times 2 contracts. There's 100 points, which is 5,000. Divide the 5,000 by 20. You get, what is that, 250? 250, divide that by 50 because it's 50 points, you get 5. That means I've moved my average price now up to 41.27. So that's it. This is just being tactical. It's adding and subtracting, and I'm not too concerned about how IB tracks my average price, whatever it tracks, because it's I think it's a first in first out or a last in last out system. I don't really care about that. I have my own spreadsheet where I track my own average price. So sometimes the number on IB, it'll say your average price is 41.64 when I know it's 41.22. Well, right now it's a little over 41.30, 41.31. Actually higher today because I did another trade. But that's all I do is, whatever I add up here, I got to be comfortable with it. I'm certainly not going to double my position. But, another 10% more or 15% more at targets that I predetermined. So, if the market's at, well, what are we now on the contract? Well under 41, 40.60. So if I see it rally back up to like 41.60, 41.70, I probably wouldn't take another short on it till I see it get to that position. What do we got? Okay, another question about 0 days to expiration. If only you could have bought calls on a snowblower to hedge your back pain risk instead of purchasing one outright. Well, owning a snowblower is a call on future snowfall, all right? A call that's not really worth much right now. And owning a snowblower, I'm probably, given global warming in 5 years, probably looking at a pretty hefty impairment charge on that thing. Let's see. Do you have an opinion on passive flows distorting equity markets? I've heard that before, that all this passive money coming in, but passive money's been coming into markets for decades. It's called pension funds. Every 2 weeks, billions of dollars flow into markets from payroll deductions and company matching plans in pension funds all over the U.S. every single week. How many, 164 million people have a job? And if every employee has a deduction for a government-sponsored pension, at least, all of that money flows into markets every single week. So I don't see that as an issue. I don't think it distorts equity markets. I think passive flows like that probably reduce the volatility of equity markets, because that money comes in. You can think of it as a long-term buyer that's ready to dollar cost average every 2 weeks. It comes into the market. This is something Michael Green has written about at length. Wasn't sure if you're familiar or could opine. I just, I've heard this argument for quite a long time now, and I don't know. I'm not too concerned about it. And if it's distorting equity markets, if it does in fact distort equity markets, great. That's what you want. You want distortions in equity markets. You want inefficiency in the market. Because if you have experience and there's inefficiency, it's like shooting fish in a barrel. I want inefficiency. So, if it is doing something like that, I would say to Michael Green, shh, shut up. Don't tell anyone. Just shut up. Don't tell it because it'll end. Just keep it to yourself, okay? So, if it is distorting equity markets, well, being that we know that this is going on, how do we use it to our advantage? Don't sit and complain about it and pound the table. How do you use it to your advantage, right? I'm unable to view some CFA Level 1 videos on your page. They're all gone. The 2017 Level 1 series on my channel is gone. If you go to markmeldrum.com and register for free, you will get the 2018 Level 1 series. Isn't that clever? It's been on YouTube long enough. It served its purpose. It was to, raise awareness of what I was doing so that people could experience the way I did things. And if they like it, off they go to markmeldrum.com. Built a nice, big, successful business off of that, but it served its purpose. 2017 is rather dated. Let's put the 2018 on my channel, on my website, and it's still free. It's still free, so off you go. Let's see. When you say it meant 1930, I also sold options. What exactly do you mean? Oh, I'd have to go back and listen to what it means when I say I also sold options. You sold options which you had bought. Oh, I already answered this. You're very confused about the options. Options are publicly traded. They are contracts that you can sell or buy at any point in time. They're not owned by any company or anything. That's just an option. If you don't understand options, don't do it. Till you learn what options are, don't touch them. 0 days to expiration. That's a big thing, right? No thoughts on that at all. I think we're almost done here, by the way, because the comments are just getting shorter. The shorter ones are at the end, so bear with me. We're almost done. Why would the Fed have to lower interest rates in recession? Because they have to support the economy. And usually you're lowering interest rates because you're trying to help credit markets and you're trying to stop asset prices from plummeting, especially on interest rate sectors like housing and autos. Not only that, with lower rates, you're encouraging individuals to go buy a house or buy a vehicle because the cost of financing is significantly lower. Even assuming there is a recession, and that helps bring inflation down to the low 4% level, if there is an inflation, it will bring it down below zero. The quickest way to get rid of inflation is a recession. Why wouldn't the central bank keep rates higher to bring inflation down to 2%? The recession will take care of that. It seems that underlying your assumption is that inflation will resolve itself if there is a recession. It's not an assumption, it's an empirical fact. Inflation disappears in a recession. It goes negative in a recession. Not deeply negative, but it does go negative. At what point do we begin to run up against a credibility issue with the Fed? Well, that's a good question to ask. I think if the Fed raises their inflation target, you got a credibility issue. As long as they keep rates high and they keep their eye on the goalpost, which is inflation, right now I think they're quite credible. I think they can probably fix their credibility problem a lot if they just stop Powell from doing press conferences. Send someone else in there, or keep him on script. The moment he goes off script, there's the credibility issue. If the Fed follows through with lowering rates in a recession while inflation is persistent, well, that's the thing. It won't. But let's assume that it was. Let's assume inflation was persistent in a recession. That would be a very difficult and very curious situation to be in. That would be a hard thing to fix. You'd have to bring fiscal intervention in there. Powell would have to walk into the White House and say, enough of this bullshit. Here's what you're going to do and here's what needs to be done because I can't do it anymore. The fiscal would have to come in. Won't that lead to the same strategy Arthur Burns is vilified for? Yeah. Why wouldn't the Fed keep rates higher for longer to extinguish inflation even if there is a recession? Well, that's, again, assuming that magically somehow inflation doesn't disappear in a recession, which it usually does. So I think we can move on this one. Now go along, snowblower, short natural gas. Short natural gas, no kidding. I looked at nat gas today. Contracts are just sitting above the $2 mark. Wow. Did that get murdered fast? Should have seen it though. I mean, January was just an incredible a month. Still sitting here, no snow. Still no snow outside. Snow blower in the garage. Used it once. That's it. No snow. Not a single drop on the ground. Unbelievable. How does higher interest rates affect PPI? How does higher interest rates affect PPI? Well, PPI is the producer price inflation. The thought is if you have higher interest rates, it will keep prices down. PPI measures prices received by producers. So if we see prices received by producers lower, then higher interest rates are working. By lowering the demand for their output, and if you have lower demand, the only way that you can make your numbers is to lower your price to increase your volume, right? Careful about saying I'm concerned about 4,500. Tesla doubled in 30. Yeah, no kidding. This makes no sense to me of why it would double in 30 days. I keep hearing the price, the market cap, 3 trillion. You know, they were saying 3 trillion when the belief was they'll grow at 50% a year, 30% margins, and full self-driving is just around the corner. Now they're thinking about margins that are about 10 points lower. They're growing much lower than 50% a year, and full self-driving is not around the corner. Yet somehow it's still a $3 trillion company. Oh, 3 trillion. Without considering that the very thesis you had for 3 trillion is got a punch in the face on its growth rate, a punch in the face on its margins, and believe it or not, full self-driving is not just around the corner. Yet there it is again. So hope. You know, I really do think that probably 90% of the price move in Tesla is due entirely to people wanting to be Elon Musk. And probably has very little to do with the actual vehicle itself, because it's not an attractive vehicle. It doesn't turn heads. You see when you go, it's kind of average looking. Looks average to me. Yeah, well, I think you know my views on that one. I don't think it's a bad company. It's just a bad investment at these prices. It's really, you're gambling at these prices. Yeah, it's doubled in 30 days, but in any rational world, that's not an investment. That's a gamble. That's all that is. What impact does BOJ and Bank of Canada record QE have on U.S. market and the Fed's so-called, I don't know why you're saying it's the so-called tightening. I mean, maybe that's just the way the language works. The so-called tightening. I'd have to think that one through. What impact, as far as Bank of Canada, I don't think that Bank of Canada was even big enough to even matter to the U.S. I don't know. Off the top of my head, I don't have a straight answer for that. I'd have to think that one through. Let's see. He mentions the Applied series. What is that? I did give you a link. Is the title a Hot Shots reference? Yes, it is. And that is it.